All right, let's dive in today. We're looking at something pretty interesting. High-yield healthcare stocks. Specifically, the ones that could provide long-term income, even when maybe they don't look so shiny on the surface.
Exactly.
We're going to unpack some insights from a Motley Fool article, High-Yield Healthcare Stocks for Long-Term Income by Ruben Greg Brewer.
Good stuff in there.
Yeah, our mission really is to pull out the key bits of knowledge about these kinds of healthcare investments, especially the ones that maybe go against the usual thinking.
Right.
So here's a thought to get us started. What if the best time to jump into a really solid company is actually when things seem a bit rough?
That's the perfect framing question because, right now the average healthcare stock, it yields maybe 1.8%. Not exactly thrilling for income investors.
Pretty low, yeah.
But this article, it spotlights two companies that really break that mold. You've got Medtronic yielding around 3% currently.
Okay.
And then Alexandria Real Estate Equities. That one boasts an ultra-high yield. We're talking roughly 6.9%.
Wow, 6.9? That's significant.
It really is. And the interesting part is they're presented as potential buy and hold ideas because they might be going through, as the article puts it, a hard time.
A hard time. So a bit contrarian.
Definitely contrarian angle, yeah. Worth digging into.
Okay, let's do that. Let's unpack Medtronic first. I mean, most people have probably heard the name, right? But what exactly is their business? What makes them such a big deal in healthcare?
Yeah, Medtronic is, well, it's a medical device giant. Truly a major force. They operate in a few key areas: cardiovascular, neuroscience, medical surgical, and also diabetes.
So pretty diverse?
Very diverse. And the key thing is, they aren't just playing in these fields. They have a strong, often leading position in each one. They're a big fish in several big ponds.
Right. And just for scale, if someone invested, say, $1,000.
Right now, that $1,000 would get you around 10 shares, give or take.
Gotcha. Now, something that really jumps out from the article is Medtronic's dividend history. It's pretty remarkable. 48 years of annual dividend increases.
It's incredible, isn't it?
Yeah. That puts them just 2 years shy of being a dividend king. That's 50 years straight. What does a track record like that really signal about a company?
Well, it signals incredible resilience. I mean, you just don't achieve a streak like that by accident. It shows they can navigate good times and bad times.
Including recessions, market crashes.
Exactly. They've clearly managed through several rough patches, as the article notes, over those decades. And, that ties into why the current 3% yield is interesting. It's historically high for Medtronic.
High relative to its own past.
Precisely. Which suggests, they're probably in another one of those tougher periods right now. That's often when the yield looks most attractive compared to its history.
Okay, so let's get specific about this current rough patch. What's causing it? What's the actual issue they're facing?
There are a couple of things mentioned. First, R&D research and development tends to be lumpy.
Lumpy, meaning?
Meaning, big new product breakthroughs don't just happen smoothly every quarter. They come in waves. And Medtronic had a bit of a slowdown in major new product launches recently.
I see.
Though the article does say new stuff is starting to roll out now, which should help growth. The other thing is costs and what the piece calls bloat.
Streamlining?
Yeah, they're actively working on streamlining operations, cutting costs. A big piece of that is the plan to spin off their diabetes business. That's slated for 2026.
And they think that spinoff will help.
Management expects it to be accretive, so add to overall profitability right from its first year.
Okay. So putting that all together, if you're listening and thinking long-term, buy and hold, how should you interpret these challenges?
I think the takeaway is that Medtronic is making the right moves. They're addressing the issues. And their history really does suggest they know how to manage these periods and come out stronger.
They've done it before.
They've done it before. So that history, plus the current yield, makes it look like a pretty compelling long-term option, especially if you can look past the short-term noise.
Right, seeing the temporary dip as an opportunity. Okay, interesting. Let's switch gears now. From devices to real estate. Alexandria Real Estate Equities. The article stresses this isn't just regular medical offices. What's unique here?
Yeah, totally different beast. Alexandria is a REIT, a real estate investment trust. But they are highly specialized. They own these very advanced medical research facilities.
Labs, not clinics.
Exactly. Think high-tech labs needed for cutting-edge R&D. It's way different from your standard doctor's office building. Needs specialized infrastructure.
Makes sense. And for that $1,000 investment here?
Here you'd be looking at about 12 shares.
Okay. And the article mentions their strategy of building clusters, like groups of these buildings in big research areas. How does that work for them?
Oh, that's a key part of their model. Building these clusters in major hubs like Boston or San Francisco, it helps with costs, obviously economies of scale. But it also creates this powerful network effect. It makes them kind of the go-to landlord in these critical research zones.
Mm.
It helps them become, really entrenched.
Like an ecosystem.
Precisely. An ecosystem for research tenants.
Okay, but then there's that yield again, 6.9%. That's huge. But the article says they're in a transition period. Investors are worried. What's the story there?
Yeah, that high yield definitely catches your eye, but it comes with some current concerns. The company is doing some housekeeping, selling off certain assets to really focus on their best core properties.
Slimming down.
Slimming down, yeah. And this is happening while the overall medical office space, even the research side, has seen a bit of a slowdown. They've had some large tenants move out recently.
Ooh, that can hurt.
It has. Occupancy dropped a bit. It was around 95% at the end of 2024, dipped to about 91% in Q2 2025. And their adjusted FFO per share, that's funds from operations, a key REIT metric, it fell slightly year over year.
Okay, slight drop in FFO, occupancy down. So the big question,
Yeah.
how safe is that 6.9% dividend?
That is the crucial question, right? And the article provides some reassurance. Even with that slight FFO dip, the $2.33 per share they generated is still well above the $1.32 per share they're paying out quarterly in dividends.
So good coverage.
Good coverage, yeah. There's a decent cushion there. Plus, their balance sheet is strong. No major debt coming due soon, which gives them breathing room.
Financial flexibility.
Exactly. And like Medtronic, they have their own dividend streak, 15 years of annual increases. That signals commitment from the board, They seem committed to supporting that payout through this patch.
15 years isn't 48, but it's still a solid track record.
It absolutely is, especially for REIT. It suggests they prioritize that dividend.
So for our listener, why might this be a good opportunity, especially if maybe the headlines about occupancy drops make people nervous? It feels counterintuitive.
It really does. And it loops right back to that core idea we started with. Sometimes the best income opportunities pop up exactly when others are feeling fearful.
Buying the fear.
Buying the fear, or at least buying when the market is maybe overreacting to temporary issues. With a well-run company like Alexandria, that high yield might just reflect current sentiment, not some fundamental long-term problem. It's about seeing past the immediate challenge.
Okay. So it seems like the big theme woven through discussing both these companies is don't just follow the herd, go against the grain sometimes. Why is looking at good companies during hard times often a better strategy than just chasing what's popular?
Well, it's classic value investing thinking, isn't it? It's just it's easy to buy what everyone else loves, what's already gone up.
Sure, it feels safer.
It feels safer, but chasing momentum can lead you to buy high. The article makes the point that taking a less crowded path, looking at solid businesses when they're down or out of favor, that's often where you find better long-term value and, in this case, better income opportunities.
Because the price might be temporarily depressed.
Exactly.
Yeah.
You're potentially buying underlying strength at a discount because of short-term sentiment, not because the business itself is broken.
And based on what we've unpacked from the article, the history, the fundamentals, the management actions, it suggests both Medtronic and Alexandria have a decent shot at pulling out of their current funk.
Yeah, I think that's the argument being made. Their resilience, their solid foundations, and that commitment to dividends makes them look like strong candidates for patient, long-term, income-focused investors. It's definitely a long-game perspective.
So the core takeaway here really seems to be about identifying these resilient businesses, companies positioned for the long haul, even when they hit a speed bump.
Absolutely. And maybe a final thought to leave you with. Next time you see a company you like going through what looks like a rough patch, try shifting your thinking. Instead of just asking what's wrong right now, maybe ask what makes this business historically tough? What positions it for the long run? That shift in perspective, it might just help you spot opportunities that, that most other people are missing entirely.